change. What is delta? Delta is how much your premium will change, and gamma tells how much will be delta changing. So at the money on day of expiry, gamma is more. That's why we see the hero types on the day of expiry. Like we buy at 18-20 rupees some option and it doubles in intraday because it becomes at the money and gamma is more at the money on the day of expiry. Rho is the rate at which the price of a derivative changes relative to change in risk-free interest rate. So it is interest rate dependent thing. It's not going to hamper much of the option price because interest rate change only when RBI comes up with economic policy. So day to day, we do not consider Rho for any of our calculations. So when we long call or short put, then delta will be positive. Short call or long pull, delta will be negative.
Device paired.
Positive for long, that is call and put buy, and for shorts it will be negative. Theta will be positive, that means time will be in our side if we are shorters of options. Because the price remains even at that level, if we are shorting that option, may it be call, may it be put, we will be making money. So if theta is positive in short call and short put, gamma is positive in long, and rho we do not take into consideration. So delta is positive for long, it might be call long, or short put, delta will be positive. And theta will be positive when we are sellers or writers of the option. It will be on our side. So time will be on our side when we are options shorters. Next is volatility. So there are two types of volatilities: historical volatility and implied volatility. So historical volatility measures how much price of underlying is changing. It is calculated based on actual price movement in past, and it is not much used. So we won't go into details of that. Market expectation of future volatility is implied volatility. It is referred as IB. Right? So IB is important factor in deciding option pricing. It is based on probability and it helps only to get idea, but is not sure way of knowing future price of options. Doesn't predict direction of underlying. Ideally, IB indicates only increased volatility in coming days. But increased IB is bearish and decreased IB is bullish market is the common consideration. High IB indicates inflated option premiums. Means what is implied volatility? It is market expectation of future volatility. We call it as IB, and it plays an important role in pricing of option. The premium, the 130 rupees, which we have seen, the extra 19 rupees extrinsic value will, implied volatility will play a role for increasing that from 19 to 25 also, or decreasing from 19 to 12 also, the extrinsic value which is remaining. Ideally, it increases only volatility is going to increase in coming days, high IV. But routinely, when we say that IV is very high, right? IV is very high, then it's a bearish market, and when IV decreases, it's in bullish market. So if we go to India VIX, we can get the chart of IV, volatility chart, India VIX, right? So this is daily. If we go to weekly, so can you see IV usually remains below 20 to 24 most of the days, in the range of 8 to 24 or 8 to 22 we can say, right? So what has happened from this 10, 20 IV, it shot up to 86. So what was this month? February 20, March 20, April 20, May 20, June 20. क्या हो रहा था इंडिया में? See, this is comparative. This is Nifty and this is IB. दोनों यहाँ पे मिले मार्च 20 में. Nifty from 10,900 went to 7,500 some level, right? And it shot from 22 to 86. So as IV increases, markets tend to fall. So when market is fearful, the implied volatility increases and markets are dropped. So that's an indication. Why? Because more number of people buy puts in the fear to protect their money or to make money even from bearish market, right? So you can see as IV started dropping, market started rising up. Right, IV was still dropping. So even though it was overpriced here, right, even though Nifty was 16,000, all were saying कि बहुत बढ़ गया. But IVs were very low, below the average. That was the reason we are seeing it at 17,300 Nifty today. Right, so that's the one indication when IV starts rising, we should be cautious. Clear? So high IV indicates inflated option premiums. Next comes IVR and IVP. So IVR indicates whether IV is high or low in a stock based on last year of IV data. So if stock trades between IV of 20 to 50 in last year or current IV is at 35, then IVR will be 50%. Means if stock range is suppose this is 50 and this is 20, right? So stock will be moving up and down and IV of stock will be moving up and down simultaneously. So if stock IV is at 35, then where is it in this range? 20 to 50 is 30 points. So difference from above is 15 points, difference from below is 50 points. So it's 50%. Right? If it's at 40 or let's say 45, IV is at 45, then it's at the upper range. So 30 may say 25. So almost 90% will be the IVR. IVR. So IVR indicates whether IV is high or low in a stock based on last year of IV data. Right? So it will be 50% or that calculated depending on the last year's range. IVR helps us in understanding where current IV is trading compared to recent history. Gives a trader better sense of whether the option premium is cheap or expensive. So whenever IVR is 80%, 90%, that means options are very expensive and we should avoid buying and instead we should look for shorting opportunity of those options. Whenever IVR, IVP is 20 and below, then we should be looking for buying that option. IV percentile, that is IVP tells us percent of days below last year that implied volatility traded below the current year. So if IVP is 80, it suggests current IV is highest in past year, indicating inflated option premium. So we should avoid buying and instead look for shorting. IVP helps in understanding where IV traded in past year compared to current IV. So both almost give us similar idea. IV rank will give us the exact location in percentage terms, while IV percentile will tell us that compared to, so when it was 86, it was 100%, right? It was trading above that last 1 year's range. That's why IVP was 100%. Both IVR and IVP were 100% that time. So where can we get this? We can know IV, change in IV, IVR, IVP of stocks, screen stocks based on IVR, IVP liquidity, earnings and IV change.